Your grocery bill went up during the last crisis. Everybody noticed. But here's what almost nobody realizes. It never came back down. Oil prices dropped, shipping rates fell, supply chains stabilized, and the number on the receipt stayed exactly where it was. That gap between what costs went down and what prices stayed up is not a coincidence. It is one of the most ruthless mechanisms in modern economics, one that has bankrupted entire industries, permanently redrawn competitive maps, and transferred trillions of dollars in market share from the unprepared to the powerful. The Journal of Political Economy documented the pattern. Output prices respond at least twice as fast to input cost increases as they do to decreases, and that gap persists for 5 to 8 months across diverse product categories. Every business in the supply chain rushes to push costs forward the moment they spike. But when those same costs eventually fall, reductions arrive at half the speed or slower. Every firm along the chain holds prices elevated to rebuild the margins it lost during the shock. The Bank for International Settlements confirmed the same thing from a different angle. Firms react far more aggressively to cost increases than decreases, and in manufacturing and among upstream producers, that reaction is even stronger. What makes this pattern genuinely dangerous is how it interacts with the structure of modern supply chains. Global production is now vastly more fragmented than in previous decades, which means a disruption in one location can topple manufacturing on the other side of the world. Shocks to a small number of upstream production hubs account for nearly 2/3 of the volatility of aggregate output, according to the National Bureau of Economic Research. A disruption at a critical upstream node, energy, chemicals, or semiconductors, cascades through the entire network. And at every link in the chain, the asymmetry compounds, because each intermediary protects its own margins. The aggregate effect amplifies dramatically. Economists call the result seller's inflation, or conflict inflation. In concentrated upstream markets, firms with enough market power act as price makers, pushing coordinated price hikes under the cover of sector-wide cost shocks. Downstream manufacturers absorb those elevated costs and attempt to pass them further down. Labor responds by demanding higher wages to prevent real wage erosion. A self-sustaining spiral takes hold, driven by distributional conflict, and any firm that lacks the scale, the technology, or the brand power to compete in that fight faces financial destruction. Idiosyncratic shocks, those specific to individual products, firms, or localized supply chains, account for between 25 and 30% of the forecast error variance in inflation at the 12-month horizon, and they build into aggregate inflation within 2 to 5 months. During high inflation periods, firms stop relying on firm-specific data and increasingly anchor their pricing decisions to aggregate information, which is exactly why central bank communication about inflation targets matters so much for anchoring expectations. The historical record tells the same story every time. Winners consolidate, losers disappear. Start with the 1970s, the Great Inflation that produced 4 economic recessions, unprecedented wage and price controls, and the total abandonment of the Bretton Woods monetary system. Its roots stretch back to the mid-1960s and the gradual demise of the Bretton Woods fixed exchange rate system, as the U.S. ran massive trade surpluses, offset by capital outflows, and eventually abandoned gold convertibility entirely. The 1973 OPEC oil embargo sent Arabian light crude from $2.59 per barrel in January 1973 to $11.65 in January 1974. That shock decimated the American automotive industry. The Big Three had spent decades building large, fuel-inefficient vehicles. When fuel prices quadrupled, demand shifted violently. Toyota, Honda, and Nissan offered superior fuel efficiency, high product quality, and lean manufacturing. America's response was the Ford Pinto, the AMC Gremlin, and the Chevy Nova, all plagued by rushed engineering and inferior quality. By 1980, Japan produced 11 million vehicles, surpassed America, and the Corolla became the highest production car in the world. That market share shift never reversed. The 2008 commodity supercycle exposed the same fault lines in different industries. China accounted for 40% of global steelmaking, and when demand collapsed in the fourth quarter, ArcelorMittal used its unprecedented scale to survive, slashing production by 45%, cutting 9,000 jobs, 3% of its global workforce, and reducing net debt by $6 billion in a single quarter. Smaller, fragmented, heavily indebted mills had nothing close to that flexibility. In the chemical industry, firms reliant on petroleum derivatives watched their margins disintegrate. Chemtura went bankrupt, Solutia landed in forced reorganization, and the surviving industry emerged far more consolidated. The 2008 crisis also reshaped the food industry for good. The farmer's share of the food dollar had already collapsed by nearly 50%, dropping from 27 cents in 1993 to just 13 cents by 2016. And large food conglomerates used their pricing power to push commodity increases onto consumers, while squeezing the fragmented farming base below them. Cotton delivered its own version of the same lesson in 2011. Prices surged nearly 300% between March 2009 and March 2011, reaching levels not seen since the Reconstruction era. U.S. apparel prices rose 5.4%, breaking a long deflationary trend. Manufacturers capable of rapidly switching to cheaper synthetic fibers like polyester preserved their margins. Textile mills that had bought cotton on call, locking in commitments and hoping to fix prices on dips that never materialized, found themselves trapped. Widespread bankruptcies followed, and textile manufacturing consolidated permanently toward Southeast Asia. The semiconductor crisis of 2021 through 2024 exposed a different kind of structural weakness. Legacy automakers had canceled their chip orders during the pandemic panic of early 2020. When consumer demand unexpectedly rebounded, foundries had already reallocated manufacturing capacity to high-margin consumer electronics and AI data centers. Legacy vehicles depended on dozens of primitive chips, ranging from 45 to 90 nanometers, for basic functions like braking and windshield wipers, and foundries refused to expand capacity for these obsolete, low-profit nodes. $500 billion in global losses followed. Tesla, running a vertically integrated software-defined architecture, rewrote its vehicle code to use alternative, modern, readily available microcontrollers, bypassing the entire legacy bottleneck and posting record production while competitors idled multi-billion-dollar assembly plants. AI data centers are forecast to consume 70% of all memory chips produced by 2026, which means the scarcity is not temporary. Between 2022 and 2026, the European energy shock completed the picture. Electricity and natural gas prices spiked 400%. Roughly 50% of European aluminum capacity, over 1 million tons, was curtailed or permanently shut down. Norsk Hydro and Alcoa issued force majeure notices, shuttering plants like the Slovalco facility in Slovakia. Even vast Middle Eastern smelters like Qatalum and Aluminium Bahrain faced severe operational halts due to conflict-related infrastructure pressure, driving LME aluminum prices to multi-year highs. Germany's primary smelting volumes dropped 45% in 2023 to roughly 189,000 tons. Production capacity fled to China and the Middle East, permanently increasing Western reliance on imported industrial inputs. The broader industrial machinery sector, still highly fragmented with over half its revenue from small and mid-sized companies, now sits ripe for aggressive acquisition and consolidation in 2025 and 2026. The mechanisms that separate the winners from the casualties are remarkably consistent across every one of these episodes. The first is economies of scale paired with parametric should-cost modeling. A should-cost model deconstructs the intrinsic cost to manufacture a product by quantifying every underlying dependency: overhead, variable costs, sunk costs, and acceptable supplier profit margins. Best-in-class procurement organizations use AI-driven parametric cost models to sift through thousands of component combinations, identifying hidden cost opportunities and spotting supplier margin inflation. That approach replaces broad, CPI-linked annual negotiations with active index-based price adjustments that force symmetrical pricing, clawing back margins the moment underlying costs recede. The second mechanism is procurement sophistication and design to value engineering. During the severe inflation spikes of 2021 and 2022, agile manufacturers redesigned products to circumvent the most inflationary inputs, eliminating labor-intensive production steps, removing non-essential features, and upgrading underlying architectures to avoid legacy components that suppliers deprioritize. Apple stands as the clearest example. 785 suppliers spread across 31 countries, aggressive use of prepayments to lock in pricing and guarantee dedicated production capacity, and sustained volume availability even during global supply shocks, while competitors absorb the brunt of market scarcity. The third and most powerful mechanism is vertical integration. By acquiring upstream suppliers, manufacturers internalize input profits and correct the problem of double marginalization, where both the supplier and the manufacturer apply markups that drive final prices so high they destroy demand. Delta Airlines demonstrated this when it acquired the Trainer refinery in Pennsylvania. Post-acquisition, Delta's exposure to refining margins, its overall cash flow volatility, its cost of debt, and its default probability all decreased measurably relative to non-integrated industry peers. On the corporate finance side, the damage from asymmetric inflation reaches far deeper than operating margins alone. Global supply chain pressures drove roughly 60% of the above-trend run-up in U.S. inflation during 2021 and 2022. By early 2023, U.S. inventories were growing at twice the rate of sales, and the total business inventory-to-sales ratio hit 1.36 by December 2025. Companies that accumulated raw materials and finished goods at peak pricing confronted catastrophic write-down risk under accounting standards that require inventory to be valued at the lower of cost or net realizable value. The debt side is where the real danger sits. Interest coverage for the median investment-grade U.S. company fell from 6.08 in late 2023 to 5.78 in the first quarter of 2024. For non-investment-grade firms, the median dropped to a highly exposed 2.62. In commercial real estate alone, $957 billion in loans matured in 2025, nearly triple the 20-year historical average, with another $539 billion due in 2026 and $550 billion in 2027. Average borrowing costs for lower-rated issuers more than doubled, from roughly 4.9% to over 10%. And the average U.S. corporate default risk reached 9.2%, a post-financial crisis high. Weakly capitalized banks engaged in systemic extend and pretend, assigning a 0.9 percentage point lower probability of default to distressed loans compared to well-capitalized peers, and crowding out an estimated 4.8 to 5.3% drop in aggregate new mortgage origination since early 2022. By mid-2024, approximately 10% of business development company interest income was payment in kind rather than cash, compounding principal debt at punitive rates and effectively trading a short-term liquidity crisis for a long-term solvency crisis. Food manufacturing sits at the absolute epicenter of all these forces. Total U.S. domestic food spending reached $2.17 trillion in 2024. The farm share stood at just 11.8 cents per consumer dollar spent, while the marketing share consumed 88.2 cents. And then, the 2026 Hormuz crisis hit. The Strait handles roughly 20 million barrels of crude oil per day, 20% of global petroleum consumption. Brent crude reached $119.50, and analysts warned a sustained blockade could push prices to $150, surpassing the 2008 record. Investment bank models estimate the Hormuz blockade carries an economic impact 17 times larger than the peak April 2022 disruption to Russian oil production. Marine insurers canceled war risk cover for the entire Gulf area within 48 hours. War risk premiums jumped from 0.2% to 1% of total vessel value. MSC, Maersk, and CMA CGM suspended all Middle East bookings. Roughly 450,000 containers became trapped inside the Gulf, many carrying temperature-controlled food products. The Drewry World Container Index rose 8% in a single week to $2,123 per 40-foot container. Through coordinated blank sailings, consolidated carrier alliances held the spot rate floor at $1,500, even when underlying demand stayed soft. U.S. tariffs piled on relentlessly. 25% on imported packaging materials, 50% on steel and aluminum, and tariffs on Chinese origin goods reaching a staggering 55%. The U.S. packaging category index rose 5% to $1,718 per metric ton. Aluminum can warehouse prices climbed 10.3%. Aluminum foil surged 30.5%. Tin plate steel jumped 18.2%. The gap between U.S. and global packaging costs widened to a $300 per metric ton premium. Plastic packaging dominates, with over 58% of global food packaging revenue, valued at approximately $421.6 billion in 2025, and two-year cyclical swings of 30 to 50% in polyethylene and polypropylene resin prices continuously grind away at margins. Major corrugated suppliers like Packaging Corporation of America abandoned third-party index-linked pricing entirely, eliminating the neutral benchmark food manufacturers had relied on for decades and exposing them directly to unmitigated supplier pricing power. The fertilizer transmission channel could prove the most damaging of all. Natural gas accounts for 70 to 80% of ammonia and urea production costs. Between 25 and 30% of global nitrogen fertilizer exports transit through Hormuz. Within 48 hours of the initial 2026 strikes, North African urea prices surged nearly 20%. European natural gas prices spiked 45%, and Middle Eastern producers suspended export offers entirely. The pass-through math closes the loop. Long-run pass-through coefficients for food manufacturing range from 0.40 to 0.80, meaning a 10% systemic input cost increase ultimately produces only a 4 to 8% output price increase. 8 quarters, a full 2 years, is how long it takes to pass through just 80% of a given shock, and in the food service sector, the lag stretches to 15 quarters. The asymmetry reaches deep into contracts. Input price reductions are passed through with an additional 2 quarters lag compared to increases, as firms deliberately hold prices elevated to recoup lost income. Food retailers capture roughly 35% gross margins on private label sales versus 25% on national brands, and that 10-point spread drives aggressive store brand expansion. A 1% improvement in price realization generates a disproportionate 6% impact on profitability. But a K-shaped consumer economy caps pricing power from the other direction. The price gap between private label and national brands has grown 38% since 2019, with consumers deeply fatigued after years of elevated grocery prices and pervasive shrinkflation. Asymmetric input inflation is not a transitory event that passes in a quarter or two. It is a permanent structural feature of how modern economies process cost shocks. Manufacturers that treat procurement as a transactional function operate within fragmented markets or stay tethered to legacy technologies will absorb these shocks, and the result is always the same: margin compression, working capital starvation, and eventual absorption by the very firms whose resilience allowed them to survive. The market share shifts that follow inflationary crises rarely reverse. They permanently redraw the industrial map, penalizing rigidity and rewarding systemic agility. The companies that come out the other side are those that treat the supply chain not as a cost center to be minimized, but as an architecture to be actively, continuously redesigned. Because the next shock is never a question of if, it is only a question of when.